Hi everyone, welcome to Your Money, Your Call. I'm Nina May. Well, joining me tonight to discuss today's market action and of course take your calls live on air are Roger Montgomery from rogermontgomery.com, and for a technical point of view I'm also joined in the studio by David Thang from Fat Profits. Closed in the red today, really weakness across the board in major sectors pretty much everywhere. The stars did not align for the market today, you could say.
As you know, having been on the program several times, I've said that the market seems to be a little bit expensive. The intrinsic value of the ASX S&P 200 over the next couple of years actually rises based on expectations for earnings. But given that it's run ahead of itself, what that means is that, that the value has to catch up. Now, just because the price is above the value doesn't mean the price is going to come down. It could be that it treads water and value catches up. But I suspect what will happen is many participants will now wait to see what the full year results look like. And if we see surprises to the upside in terms of profit and profitability, return on equity, then what will happen is the market will go ahead again. If that doesn't happen, then we might see that period of consolidation extended. But I can't find many things to buy. I think there's 3 or 4 companies that I think are really top quality A1 type businesses that are below their intrinsic value. The rest seems to be a bit expensive.
Let's see if we get any callers discussing those ones tonight. We'll wait and see. Well, Roger and David, we've got our first caller waiting on the line, ready to have a chat with you. I'm going to go to Brisbane to start with, and we've got Ben waiting there. Hi, Ben.
Hi, how you going?
Hi, well, thank you.
Good, thanks. Just wanted to get a charts view on Fairstar Resources. They've jumped about 4 cents in the last couple of days and sort of getting over that 10 cents. I was just wondering if the panel could give me some idea where that's headed, please.
I understand this company's commenced drilling, so that could be the catalyst for the increase in the share price. But let me say this, it's never made any money. Its intrinsic value is 0. And that's, as you know, I value companies based on their profitability. So the company doesn't make any money. It's not worth anything at the moment. There are a lot of people in this space that would disagree with me, but I value these things on a going concern basis. So I can't offer any other insights other than it has a value of 0 and it's never made a profit.
Okay, let's go to our next caller. We've got Scott, who's dialed in from Melbourne. Hi, Scott.
Hi panel, how are you tonight?
Hi, really well. Thanks for joining us this evening.
Thank you. I'm after a technical analysis on IRESS Market Technology and whether or not the panel is believing the recent rumours that the ASX might be looking to take it over.
This is one of those handful of businesses that I refer to as my A1 type businesses. Really high quality in terms of the balance sheet. Predictability of performance is going to be fairly easy, a fairly consistent performer. The value, though, the intrinsic value of this business is substantially lower than the current price, and I suspect the current price has some enthusiasm around it because the ASX no longer has its regulatory shackles on it. Globally, when an exchange loses that regulation role, they get taken over. So there's that aspect. I don't know whether or not the rumours of the ASX taking over IRESS are right, but what I do know that with Chi-X coming in, the ASX will still dominate and monopolise settlement and clearing in terms of revenue, but there'll be new platforms. Brokers will need new platforms to actually provide execution on 2 exchanges. So a broker's job will become trying to get the best price on either of those 2 exchanges at any moment. Now, IRESS seems to be a platform that's well positioned to take advantage of that, and I suspect that's why there's some enthusiasm for this particular company. Having said that, though, I've got the intrinsic value currently at $5.71 going to $6.56, and as you've already seen, the share price is significantly above that at the moment. So a great business, but not a bargain.
Our next caller is on the Sunshine Coast. We've got Tom. Good evening to you, Tom.
Yes, hello, Nina and the panel there. You're doing a great job, and of course, Nina, you're looking as lovely as ever.
Oh, Tom, that's very nice. Tom,
is this the same Tom? Is this the Tom that rings up every time I'm on the show?
Well, look, I don't think Tom's a relative.
Right.
Thanks for dialing in, Tom. How can we help you tonight?
Yeah, listen, it's regarding MST Metalstorm. It's a little Brisbane company that's just been awarded the biggest contract actually in the history of the company since they've been going, to supply the US military a non-lethal Yeah, non-lethal multi-barrel control system, actually. It's a weapon, actually, and it's massive news. The company was on the brink of collapsing, and it's been a big turnaround, and it can only get better from here. So I'd just like to get a technical view and, obviously what the panel thinks. So.
Yeah, now this announcement that Tom's referring to came in a couple of days ago. This company's a weapons developer, as Tom was saying. It's scored a contract with the United States Marines for a mission payload module non-lethal weapon system. Now this is valued at about $1.5 million, this contract. So this is where the company's sitting at...
$1.5 billion or
million with an M.
$1.5 million?
Yes.
It's not a lot of money, is it?
That's what it says it's valued at. The contract's scheduled to be completed in 12 months. So, look, I'll start with you on this one, Roger. So, with the company Metal Storm, and that's how the chart's been looking.
Can I just take a position? I have no interest in buying a company that manufactures weapons. Just not interested. I think there are other things that I would rather make a profit from than... And I did hear the word non-lethal. I'm very happy to hear that. But if the company continues to manufacture weapons that are designed to kill people, I'm just going to morally say that I'm opposed to that. And company can continue to exist. I'm just not interested in investing in it. It hasn't made a profit for a very long time or ever, and so its value currently is zero. It'd be interesting to see when this contract and what it turns into filters through. It'll be interesting to see what that means for profitability, but at the moment, based on its track record, it's not worth anything. The comment you make, though, comparing it to 10 years ago when the share price was up at sort of $3.17, over long periods of time, price tends to follow value. So if value zero and the price is at $3.17 and the value doesn't increase, guess what? Price is going to catch up to value, and that's what we're seeing at the moment. We've seen the price go from a high of over $3 to virtually zero at the moment.
It's about 1 cent.
Gentlemen, let's go to an email that I've received from Stuart in Melbourne, who would like to get your opinion of the healthcare sector in general. In particular, he's looking at Sonic Healthcare, which is stock code SHL in the short to medium term. Take a look at the broader healthcare sector with you, Roger, and perhaps you can also let us know where you put Sonic in amongst the group.
Yeah, look, the reality for all of these businesses is they're in the right space. We've got an ageing demographic. That's good for business. You want to buy businesses whose customers are growing. There's more and more customers. That's generally a good space to be in. But the thematic there has really resulted in the share prices for all these things being way above their intrinsic values. In this space, there's two companies that I absolutely wouldn't go past, and that's CSL and Cochlear. I think they're two, if not the best businesses in healthcare, some of the best businesses on the entire Australian market. And when I look at these other businesses, let's take Ramsay to start with. I'll come back to Sonic in a second. Ramsay's trading over $14 at the moment. Its value is going up, but its current value is $6.81. If I look at Sonic, Sonic's currently trading at over $14 as well. Its intrinsic value is $9.55, going to $11.07 and $12.49 over the next couple of years. So they all tend to be much of a muchness in that regard. Primary is another one, and Primary Healthcare is trading at close to, call it $4.40 or thereabouts, but its intrinsic value is $2.59, going to $2.80 and $3.13. It's a function of the fact that everyone likes being in this sector because the demographics are in its favour, and it's a defensive, inverted commas, a defensive space to be in. But you still want to buy the good quality ones, and the best quality ones are definitely CSL and Cochlear, and to a slightly lesser degree, Blackmores has a little bit of debt at the moment because it's building a new facility. But once that debt's paid off, it's also a high quality business.
Gentlemen, we're going to take a short break, but if you've got a question for Roger Montgomery from rogermontgomery.com and David Thang from Fat Profits, now's the time to call. There's a number at the bottom of your screen, 1300 30 34 35. Don't go away. Back with more of your questions in just a minute.